What's up, everyone? It's Karthik with Moneyvest. So welcome on board for our live stream where we break down the statement from the Federal Reserve that's going to come out in under 20 minutes. And Jerome Powell's speech is also scheduled for today. So later today at 2:30 p.m. Eastern. So that's also going to be scheduled for under an hour. That's going to be about an hour long. He's going to be asked a lot of questions related to, monetary policy with regards to interest rates, inflation, economic growth, expectations around unemployment. So we've got a very, very important day. The markets are, of course, ripping higher on the day. QQQs are up a little bit over 2%. S&P also pushing higher with a lot of individual stocks, including Tesla, AMD, Nvidia, all just rallying significantly here on the day. So if you guys can see me and hear me, just give me a thumbs up. I just want to make sure the audio and the video is working well. There are no problems and no issues related to the audio and the video here. And this is going to be my screen with QQQs pushing up a little bit over 2%. Tesla, you can see up over 3%, just a little bit under $230. And Nvidia here pushing up to over $114 a share, up over 10.4%. At the moment, with Meta, Amazon, Apple, all of them pushing up somewhere between 1% to 2% here on the day. So thank you so much for joining, everyone. I really, really appreciate it. Like I said, in under 20 minutes, we've got the statement from the Federal Reserve. So that is going to be coming out over here, July 31st. This is the last day of a two-day meeting, and we're going to get the statement, and the markets are not expecting for a rate cut in this meeting. So the next meeting that's happening in September 18th, we've got no meetings in August, but September is when the next meeting will take place. That's when the markets are pricing in for the first rate cut of 2024 from the Federal Reserve as part of their monetary policy. So we got lots to discuss, lots to unpack, and I've got a poll running right now with 168 votes. I want to ask you guys a simple question to participate. Please, could you just do me a favor and participate on that poll, and also drop a like on this live stream, and also share this live stream with other people that you might find would be interested in joining us for this live stream for Jerome Powell's speech. But let us know what you believe Powell's tone is going to be, whether it's going to be hawkish or dovish. Powell, for the most part, has sounded a little bit of both, but for the most part, in my opinion, leaning more towards the hawkish side as he continues to help us understand that we're nowhere near close to the 2% target as part of the Federal Reserve's monetary policy for inflation, and we need to see a sustainable path towards 2% as they can get greater confidence in order to, once again, cut interest rates. That's going to be on the agenda. That's going to be the question that everyone's going to be asking is, if next meeting is going to be it. Are we going to see a potential rate cut in the September meeting? So, Bhavin, thank you so much for reminding everyone. Please make sure that you drop a like and subscribe as you're joining us here. Let's take a quick look at some earnings being reported. So let me just log back in here, and we should be all set. So I'll just log in. Again, you can join our Moneyvest platform. There is a significant discount right now. We're adding more and more features over time, so that's going to be available for everyone. We're going to be adding our economic calendar. There's going to be full portfolio tracking with analytics, as well as the Moneyvest index, the market thresholds, concentrations, momentum trackers, everything. There's going to be so much data that's going to be available. And you can also do some peers analysis where you can compare stocks with other companies that are belonging to the same industry or maybe different sectors and stocks. So there's going to be a lot of things that you'll be able to do eventually. But when it comes to the earnings calendar, today we've got companies like Meta, Qualcomm, Alibaba, Lam Research reporting after the bell. We've also got Aflac, AIG, and that is pretty much going to be it. Vici Property is going to be reporting. eBay is scheduled to report. Carvana is going to be reporting. Then we've got, so those are going to be the big ones, the big names that are reporting. And then, of course, tomorrow is another big day with Apple and Amazon, two of the biggest companies in the world. And, of course, as part of the Magnificent Seven, they're also reporting their numbers. MasterCard reported, double miss. T-Mobile reported. Boeing reported with a negative $2.90 in earnings per share. Revenue coming in at just over 16, almost $17 billion. And MasterCard coming in just under $7 billion with EPS coming in at just over $3.59 as well. I just want to know what color tie he'll be wearing. That's correct. I feel like it's going to be purple. I think purple is what he's been wearing recently. Slebe, Moneyvest platform is worth the money. Best platform for stock investors. So thank you so much, Slebe. I really appreciate that. And quite literally, I am so excited. Our developers, our team is so amazing. I really want to give a shout out to both of our developers because they're always working hard. And we've got so many features. Like if I show you my scope sheet, it is such a long scope sheet. And I'm constantly on calls with other data providers to bring amazing new data for you guys. And it's going to be, this is literally only 1% of what we want to do and want to build, right? So right now, of course, you can already start to do full fundamental analysis on individual stocks. We've also included live quotes as well as pre-market after hours quotes are also going to be available. And then of course, you can start visualizing for a lot of data sets, as well as calculate for intrinsic values and stuff like that as well. So again, link's going to be down below if you want to join, and we're going to be adding a lot more amazing features over time for all of you. So Slebe, thank you so much for that comment. I really appreciate that. So market's pushing up. QQQ is 2.4% higher, which is fantastic. By the way, we're also going to be including for ETF data very soon. So that's also going to be available on the platform. So you can not only search stocks, but you can also search ETFs in the future, and of course look at their constituents, look at their holdings, look at the entire ETF dashboard where you can take a look at their number of holdings, assets under management, expense ratios, as well as their price to earnings multiple, price to sales multiple. Everything's going to be available for ETFs as well. So that's going to be available very soon as part of our feature update. But yeah, coming back over to the market. So SPY, Baba is reporting August 8th. So yes, that's what we have as part of our database. So right now it shows August 24th. So it does show Thursday, August 24th, but on our platform, it does show for today. So we are getting the data straight from FinHub, which is directly getting data from New York Stock Exchange and the NASDAQ. So there's been some discrepancies across the board for a lot of other platforms. So for example, if you come over to, let's say, Seeking Alpha, and let's take a look at, because we were kind of debating about PayPal as well. PayPal was scheduled to report yesterday pre-market, but TradingView had wrong information. They had it on 31st after markets close. Some platforms had it for 30th after markets close, but we had it for 30th pre-market. So that's yesterday. So Tuesday, if you scroll down, PayPal was pre-market. That's when they were supposed to schedule to report their numbers. But let's take a look at Alibaba. And again, TradingView does have a different number for Alibaba in terms of earnings. But let's see. So they have it August 2nd, Seeking Alpha. But right now, our platform is showing as today, after markets close. So we'll have to check what's the correct date here. And they are showing, TradingView is showing Thursday, August 22nd. So you know what I mean? Like it's all over the place because TradingView is showing August 22nd. They're showing August 2nd. Our platform is showing after markets close tonight. So there is some discrepancies when it comes to especially ADRs when they are depository receipts. You can oftentimes get some discrepancies in the data, especially when it comes to when those companies are reporting their numbers. But coming back over to what is the Moneyvest index and where can I find beta? So MS, the beta link is going to be up top. So I've pinned it as part of the chat. You can see the pinned comment. That's going to take you to our Patreon. You need to sign up on Patreon and then automatically your email will get whitelisted and you will be able to sign up to our Moneyvest platform and have full access to the entire platform, do everything you want from stock analysis to earnings calendars to just looking at a lot of different data for a lot of different companies. So that's going to be available, and all the new features, like for example, right now you can see a lot of these things, the features coming soon at the very top, and that again, we're going to be launching over time. Every few weeks, we're going to be coming out with new features for all of you, and that's going to be at no cost to you guys, at no additional cost. So that's going to be available. So Moneyvest Index, by the way, is also going to make its way over to the platform. We're still working with a few data providers, and that is eventually going to make its way over to the platform in a nice laid out manner. You'll be able to track and see exactly where the Moneyvest Index is. And again, this has been my guiding tool for dollar cost averaging and for buying opportunities, because when the Moneyvest Index says it's buy, I buy, right? That's what I've been doing for a very long time, and it's been very precise. It is by no means an indicator that tells you exactly where the market's going to bottom or top, but these are levels that are very, very important. It kind of triggers certain levels in green where the risk rewards are very favorable. They're very discounted, and there's huge opportunities, dollar cost average in. The lowest level from our recent readings, we've gotten down to like 3.48. That's been the lowest reading, and the last time we saw that was back in May, a little bit down to 3.43, and prior to that, April was a much better, much stronger buying opportunity. In fact, I did a video of my last 20 to 30 stocks buying shopping list here, and since then, of course, the market's ripped over 20%. The QQQs rallied over 20% from back in April 20th. That was the last serious buying opportunity, and right now we're starting to see that Moneyvest index, of course, come down from highs of 4.1, 4.2 down to 3.48. But again, the lower the levels, the better that's going to be. Will Moneyvest be available via mobile app soon? Android, yes. So that is also in the works. Most likely in 2025. We're going to be working on that. Right now, our main focus is to at least get 25 to 30% of our way in when it comes to features, because we do have a lot of things. I really, would like you guys to test out the portfolio feature as well as the economic calendar. Include the Moneyvest index, includes the market thresholds, the market concentration. So it'll give you like a bird's eye view of where we are with the indices, whether we're in a dip, pullback, crash, bear market, what's the percentage concentration for individual stocks, and also Magnificent Seven or top threes or big fives. Like, that's going to give you a nice table format. So we want to build a lot of new features, especially on the macro dashboard. So this dashboard, we want to build in a lot of new features, and then we'll be focusing on building the mobile version, both web and of course the application, and that's going to be available as well. So yes, it's in the works, and we're taking all of your suggestions very, very carefully. We sit down on a weekly basis, go over all the suggestions, prioritize what do we need to work on for the upcoming week, and yeah, so really a big shout out to our team here. They've just been absolutely incredible, and to all the members as well. You've been giving us great feedback, and I really, really appreciate all of you. Will the Moneyvest index touch 3 again? If you're asking me if it's going to touch 3 again in the future ever, I would say yes. There will be a time in the future where Moneyvest index is going to be down to 3, down to as low as 2.4, 2. There will be a time in the future where the Moneyvest index is back down to 2.4, 2, or even as low as 1. That's when this is going to come in most handy. That's when it's going to be the most useful, because it's going to really tell you exactly, okay, it's time dollar cost average in, it's time to start buying. The risk reward is starting to look really good. Markets are coming down. There's discounts all over the place. So that's how I utilize this indicator, right? It's not an indicator that's telling me that, oh, it's the exact bottom, but it's telling me that, okay, this is a time where I can start dollar cost averaging and start buying back into the market. Can the markets go even lower? They sure can, and that's when the risk reward will get even better, right? So that's our analysis of how can we minimize risk and maximize profit potential for ourselves, right? That's the whole idea. So coming back over to some of the individual stocks to quickly analyze. The numbers come out in 5 minutes. 5 minutes, we get the statement from the Federal Reserve. So that number is going to be released right over here. Remember, markets are not expecting for any type of increases in rates or decreases either. So no rate cuts, no rate hikes expected from the Federal Reserve. And as soon as the statement comes out, we're going to learn more about what the Federal Reserve is planning to do. And again, in 30 minutes, we'll get the Jerome Powell speech also on Federal Reserve's YouTube channel. So we'll listen in to what Jay Powell has to say for interest rates and inflation. Also, do participate. 300 votes. We're trying to get to 500. 500. Let's see if we can hit 500 prior to the meeting. So then in the next 30 minutes, let's see if we can get up to 500 votes for the poll, which is asking you whether Powell today is going to be hawkish or dovish. So definitely do participate in our wonderful poll here. My nerves are bad. Don't mess this up for us, Jerome. Yeah, markets are ripping right now. So Jerome Powell definitely has the potential to throw water on this rally, because we do have QQQs up over 2.6%. That's an incredible move to the upside. We've got SPY pushing higher, Tesla's up 3.6, Nvidia is up 11%. Just an incredible run up here. Advanced Micro Devices also up almost 3%, and Apple's up over 1.6. I mean, Nvidia, for example, is literally just adding over $300 billion in market cap in just one day. That is a lot of liquidity flooding back into Nvidia. Huge momentum, almost 11%. I sold a put. I did also pick up shares of Nvidia. So we'll of course continue to dollar cost average in at around $96. It was in a pretty decent bear market yesterday, down over 27%. And now, of course, we're back into a correction territory, only down about 17%. So Moneyvest Index is more loyal than Lamine Yamal's girlfriend. Been loyal to me since 2021, MS says. Yeah, I mean, I saw the reels. It's definitely not cool. And I'm sure he's gonna bounce back stronger. He's gonna use that as motivation in the upcoming season, and it's gonna definitely kick ass. And he is, I mean, one of the greatest talents that we're seeing, one of the greatest youngest talents that we have in the world of football, and of course in the world in general. So I feel like he's got a long way ahead of him if he's gonna rise to the top. Okay, so 2 more minutes. How are meme stocks going to do, Caddy, after interest rate cuts? I feel like there could be some euphoria around meme stocks because they're heavily shorted. And as interest rates start to come down, that's always a good environment for meme stocks. But you know what was interesting? It was actually quite interesting. I was looking at ARK Invest, and what was funny was that how can you possibly pick a set of stocks that when the entire markets are going up, these stocks don't go up? When the markets shift and rotate out of big tech over to small caps and IWM, it's time for the neglected parts of the market to rally. It's time for small caps to rally. And even then, ARK is not able to find any breaks. So how is it, like literally, if you think about it, it's just in this small section, which is ARKK stocks, that just don't seem to find any breaks. Big tech rallied, now small tech is rallying, or small caps are rallying. ARK is just not moving. So what kind of stocks would you have to pick in the entire universe of stocks to miss out on both types of great rallies? It's just incredible. Because ideally you think that if small caps are moving, by the way, 15 seconds for the numbers to come out. So let's just switch gears very quickly, come over to QQQs on the, let's say, 15-minute time frame. Again, we're looking for no rate cuts, no rate hikes. I'm going to keep reloading this. Here we go. We're 2 p.m. Eastern here. 2 p.m.'s already hitting the clock. We are just waiting for the statement to be released. And as soon as that comes out, I will take a look at what that is going to say. There we go, where we have the PDF. And let's see. The committee seeks to achieve maximum employment. They're keeping the rates at 5.25% and 5.5%. So 5.25% and 5.5%. So no rate increase and no rate cuts either. So the statement, as expected, I don't believe the markets to move all that much on this news because this was exactly what we were looking for. But yes, the statement is out. And in support of these goals, the committee decided to maintain the target range for the federal funds rate at 5.25% and 5.5%. And in considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate, very important language here, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence, something we have heard many times before, that inflation is moving sustainably towards 2%. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and mortgage-backed securities, and the committee is strongly committed to returning inflation to its 2% objective. So a copy and paste. It's almost such an easy job. You copy and paste the entire statement. It's the same exact thing. But yes, we were not expecting any type of movement on interest rates, and that's exactly what we got. 5.25% and 5.5%. That's exactly where we are. Okay. I need help with MVIS stock analysis. I'm stuck in since 2021 when it had a short squeeze. I've been dollar cost averaging ever since. My average is 165. I'm down 43,000. Wow. Emma, I feel sorry for you. Really need to get out of it. So let's take a look. Let's just take a quick look for Emma here because she's definitely down quite a bit. So hopefully we can provide some guidance. By the way, everyone, do share your analysis on as well. If you are also looking into Microvision or you've looked into the stock before, definitely do share your thoughts so that Emma can make a more sound decision with her position. So definitely do share what your analysis is going to be. So a few things I would say is definitely fundamentally not a good company. I'm sure you're not going to get a good M score if you are looking at this stock. So MVIS. Let's take a look at Microvision here. So let's see what the M score is. There we go. So we got 2.68. So score is really low. And if it's slightly orange or red, that simply means that it is just not a high quality business, right? So M score is just one of our ways that we have designed to evaluate companies and assign a numerical value. So higher the M score, the better it's going to be. For example, if I show you NVIDIA, it's going to have an M score which is closer to 4. There you go, 3.9 out of 5. If you look at Lululemon, by the way, Lululemon, in fact, is one of the highest M score stocks on our platform at over 4.3, extremely green, right? So that's good. If you want to do more analysis, you can always come over to the company's metrics here. So let's just go over the last 7 years. Take a look at revenue. You can see it's been very inconsistent. Declining is our checkpoint. Operating income, net income has been negative. You can see the losses just mounting over. You can see that it's downward. That means it's losses here. Margins are worsening, as you can see. We've got highly inefficient across the board for efficiency. Scores are really low, 1.5. Financial table wise, I mean, it does seem like they have net debt negative, more cash than debt, but we'll have to take a look at that on the quarterly numbers. So if you come over to quarterly numbers, last 8 quarters, and if you come over to balance sheet, total cash, looks like they're sitting on $73 million with a long-term debt. Short-term debt is nothing, long-term debt also zero. So maybe you can make a case that they do have more cash than all liabilities combined. So yes, maybe the bankruptcy risk is low, but there is little to no growth for this company at the moment. And analyst estimates wise, we got a hold rating with price targets well over $3, but we've got little to no growth, negative to then turning positive starting 2027. So 2027 is when they're expected to turn profitable. Kevin, sell calls to reduce cost basis. Yeah, so I was also thinking about that, but I'm guessing her cost basis is way too high to even get anything out of calls, because for a stock like Microvision, I doubt anybody's going to be buying calls right now. So premiums are going to be absolutely nothing, next to nothing, like absolutely peanuts, which won't allow her to lower your cost basis all that much. But that is something that you could do. Now, one of the solutions which I have is a very, it requires a lot of brave, like you need to be very brave in order to employ this solution, which I've kind of flirted with PayPal. One of my positions that I'm down on is to DCA very aggressively as you can, to bring your cost basis to as close to the market price as possible, then sell calls that are close to the cost basis and try to get out of that position or salvage as much as you can using that methodology. But it does require lots of capital and lots of bravery. So I don't recommend it, of course, unless you're willing to go that route. I've only really done it, I think, once. But other than that, it's very, very difficult. So, but yeah, I mean, one of the things about stocks is that sometimes you just got to take your loss and move on, and you don't have to make the money back from the same stock that you lost it from, right? That's the interesting and the cool thing, is that there's plenty of other stocks out there that have opportunities and potential that you can generate a gain and recoup a lot of the money that you lost from other bad picks. So, okay, coming back over to some of the questions. Is the press conference today from Jay Powell? Yes, the press conference is going to be starting in under 30 minutes. Caddy, explain the Moneyvest Index, please. So yeah, Moneyvest Index is really just our calculation of a lot of market breadth and technical indicators. So what I've done really here is I've taken into account a lot of different specific indicators and metrics. I've put them together into a calculation that calculation spits out a number, which is the Moneyvest index. And that Moneyvest index, which we have essentially back tested across over the last 15 to 20 years. So if you come over to Strategy Tester, you'll notice that we have essentially seen a percentage profitable through back testing of 99.19%. So you can see that the percentage of winning trades, the number of winning trades divided by the total number of closed trades. So overall 124 closed trades, 99% profitable, with a drawdown, max drawdown of about 1.5%. An average trade yielding about 25%, right? So those are pretty good statistics. We analyzed over 160 trades and 124 of them being full closed trades. So that, again, is a pretty good back testing that we were able to do for this index, which has been created. So that's why I use it so often to better understand market's technical positioning. All right, so coming back over to, let's take a look at the market's reaction. If we have anything, QQQs are still up 2.6% as expected. We're not seeing a big move in the price after the statement release. And most stocks are still, Tesla's still up almost 4%. Nvidia's up over 11.4%. So again, a lot of companies still pushing higher. Yes, Monique, Powell is talking today. So in under 30 minutes, Jerome Powell is going to be coming online and talking in front of the entire world, basically, and also answering questions from the press to better understand monetary policy, interest rates, inflation, all that good stuff. So yes, he's going to be talking in under 30 minutes. We also do have a poll, so make sure that you participate, and whether you're expecting Jerome Powell to be hawkish, dovish, targeting 500 votes here by the time he gets going on the podium here. Okay, let's take a look. By the way, I really want to know where you all are joining from, so let me know in the chat what part of the world you are joining us from today. I would love to know. Shout out to every single person for coming online, joining us here. We're gonna find the Moneyvest software. So again, there's a pinned comment, MS. You can pretty much get access to that through this link over here. So this is the link that's gonna take you to the platform where you want to sign up, and then you'll have automatic access to the Moneyvest platform. All right, let's see where you guys are joining us from. And I want a lot of comments to flood the entire chat. Nolas, my DCA for PayPal is quite high. I think it's in the 120s. I'm down like almost 50%, man. Not doing super well on PayPal. Okay, so we've got Texas in the house, Florida, Kansas. We got Ohio, California. We got Norway, San Jose, Toronto, Texas again, Hawaii. We got London. We got Boston. Awesome. Let me know, everyone, where the 343 of you are joining us this morning. Kevin's joining us from the moon. That's awesome. Stockholm's in the house. Pennsylvania, Michigan, Vancouver, Toronto, Norway. We got Texas. We got Georgia. We got Portugal. Shout out to all of you guys. Thank you so much for joining. I really, really appreciate that. Belgium, sunny Florida, Finland, China, Toronto, Indiana. Okay, let's see what country represents most of you guys in terms of audience-wise. Like, I really want to know. Like, I'm guessing it's gonna be either the U.S. or Canada, but I really want to know like what country. So instead of putting cities, let's see what country you guys are joining us from. I'm gonna guess it's mostly gonna be in the U.S. So we got California, New Mexico, Kentucky, San Diego, Minnesota, Texas, Seattle, hot California, Arizona, South Carolina, Montreal. Awesome. Netherlands. Saskatchewan, man, you know what? I was this close to going to Saskatchewan, moving to Saskatchewan, in fact, but I didn't. I decided against it. Edmonton, do you mean Edmonton, Veer? Again, Edmonton, I believe it's in Calgary, right? I could be mistaken. Or it's in Alberta. Alberta is the province, I believe, if my geography serves me right. I believe it's Alberta, which has Calgary. Man, I don't want to make a fool of myself. I believe, I hope I'm talking right. Okay, Romania, we got Dubai. Wow, couple neighbors here. Sweden, Pakistan, Canada. Awesome. Great, everybody. Thank you so much for joining. Really appreciate it. Jerome Powell doesn't doesn't know. We've got people from all over the world waiting to listen to what he has to say. So it should be a very, very interesting time. How many people here are expecting markets to rip after Jay Powell or during Jay Powell's speech? Or are you expecting the markets to go down? Throw in ones in the chat. Ones in the chat if you expect more rally. Yeah, Calgary, Alberta. Or 2 in the chat if you're expecting the markets to come down and start rolling over. So let's see. 1, where you expect a bigger rally, more green in the markets here. Or 2, if you're expecting a sell-off, a bigger sell-off in the markets here after Jerome Powell starts talking or if he's done talking. So let me know. Ones, I'm seeing a lot of ones, more ones. Wow, lots of people ones here expecting the markets to rip. Steady, then rip afterwards. How much can it go up from here anyway? True, I mean, it's already up 2%, 2 to 3%. I mean, QQQs are up 2.7. S&P is up a little bit over 1.6. So definitely a very strong move intraday. Nice bounce. So Nakul, yes, is recession likely early next year considering yield curve will be uninverting? I think the biggest indicator for us to track whether there is unemployment is going to be, whether there's going to be recession is going to be unemployment. So in order for us to better understand whether we are going to see a recession or not, I think it's really important to track unemployment. And tracking unemployment can come in various ways. We can look at jobless claims. We can look at layoffs. We can look at the unemployment persons. We can look at the unemployment rate. There's a lot of ways to look at it. But I do believe that if unemployment continues to increase, which by unemployed persons, the trend is moving in that direction where it starts to accelerate slowly and steadily. And every single time when interest rates have been higher for longer, sooner or later, unemployment has increased significantly. Aftab, Caddy, have a healthy drink now. You look stressed. I am. To be honest, I have been stressed. I was sick over the weekend. Kind of burned myself out last week. I was overworking too much. I feel like this week has also been kind of similar with the earnings and the Jerome Powell speech and the unemployment numbers coming out. So it's been definitely very, very stressful. Lack of sleep, just a lot of work, content, and then also on the platform. It's just been a lot of work. Excuse me. I still have a sore throat right now. I do have cough. Excuse me. But yeah, so the treasury yields definitely an important indicator as it has been in the past. The inversion has been, this is one of the longest inversion is what we've seen, over 500, almost 600 days of inversion. But right now, negative 25 basis points, and it's starting to move back higher to the positive territory. And as it does, that's when the recessions usually begin, right? It's not on the way down, but it's on the way up that recessions usually take place. And it's happened back in 2020. It's happened back in 2007, 2008, happened back in the dot-com bubble, happened back in the 1980s, going into 1990s. So it's definitely been a strong indicator. But I think unemployment is really where it's at. I think unemployment is where we're going to have a much better idea whether there's going to be a recession or not. Relax, young man, Tony says. Yeah, I mean, thank you. I appreciate that. Bro, you need to let your money work also. Don't kill yourself. Let the wagey do it. MS, how tall are you in centimeters and weight? I think I weigh about, I want to say like, how much do I weigh? Like 70 kilos. I'm not sure how much that is in pounds. It might be like 160, 165. And then I'm 5'10". But I don't know why'd you ask me that. Does my stress has anything to do with how tall or how much I weigh? But so last few videos you mentioned the name Karthik. Yeah, so Karthik is kind of like my official name. It's Kartik. It's a shorter version of my actual name. So since just wanted to use that as because Caddy used to be like my nickname, and I just want to switch over to like the actual name, and so that's my official actual name, Karthik. So yeah. Will you relax more if you get green all the way? Like, to be honest, like, markets don't really stress me out. Like, honestly speaking, markets don't even stress me out. It's never been the markets that have stressed me out. I mean, either way, if markets go up, that's great. If they don't, if they come down, that's buying opportunities, right? So, I'm always excited for sell-offs, and I'm kind of normal when the markets are moving up. So markets volatility have never really stressed me out at all, ever. Sergio says, what exactly are you doing in Dubai? Just for curiosity. So, I mean, are you asking like, why did I move here? Or you're asking what my day-to-day looks like here in Dubai? What exactly do you want to know, Sergio? Happy to answer. But anyway, going back over to the markets here. Northwestern said, if you were to trade looking at the 4-year, 8-year, and invest with a printer, exit with the Fed, oh man, you would be rich. I don't understand. Yeah, closed captioning would do you dirty. I'd watch with the volume down, and closed captioning would have a new name for you every time. I know, Steve. That's happened so many times. I know it's happened. I have seen that myself. Closed captioning for YouTube, unfortunately, isn't very strong. I've seen that myself. Yes. So Caldron FOMC statement has been released. So this right here is the statement which we got. No changes to the interest rates, keeping them where they are, 5.25% and 5.5%. And again, the markets are not really moving all that much. I mean, we're slightly higher from where we were pre-statement, but of course, there's not a lot of movement because this is exactly what the markets were expecting. In 12 minutes, we've got the Jerome Powell speech starting, so we'll listen in to what he has to say, and I'm sure the markets will be reacting quite aggressively when he starts talking. Right, so in about 12 minutes is when we'll listen in to Jerome Powell. Tara says, I visited India like 20 years ago when I married my wife in Kolkata. That's great. That's awesome, man. My sister-in-law is also from Kolkata. That's incredible. I've been there a couple times myself. My nephew is also from Kolkata. So, wow, that's incredible. Oh yeah. So yeah, just working in Dubai. Company's based out of Dubai. So that's what I do. Yeah, no taxes in Dubai for stocks, capital income, corporate tax. Corporate tax recently announced last year, 9%, but other than that, income tax, capital gains is not there, is not here in Dubai. Okay. Yeah, but my day-to-day kind of looks, I would say it's pretty much occupied with work. Don't really go out much. I should maybe start doing that. For the first 3 months I saw you, I thought your name was Scotty. Yeah. Anyway, so let me know if you have any questions prior to the meeting starting from Jerome Powell. 10 more minutes to go. If you have any questions, let me know. I'm happy to answer related to the macroeconomics, inflation expectations, interest rates, the statement that was just released. There's nothing new in the statement. We already have heard the same language in our previous statements. And I'm sure that Jerome Powell, for the most part, is going to be talking about very similar things. At least this is not going to be as dreadful as watching the testimony in front of Congress. It's going to be nice and quick, only an hour, with some nice questions around interest rates and monetary policy. And I think that's where the focus needs to be. So, have you seen Deadpool and Wolverine? I've never really been a Deadpool fan. I don't know if that's going to trigger people here, but I didn't even watch the first Deadpool movie. I've been a huge Wolverine fan. What's his name? Is it Hugh Jackman? Is he the guy who actually played Wolverine? Yeah, he is, right? Yeah, I've seen that, but I've never really been a Deadpool fan. Oh, he's still in the new movie. Okay, maybe I'll watch it just for Wolverine, but I've never really been a Deadpool fan. Well, I don't even know what's his superpower. What is Deadpool? Like, I don't even know. Alta, yeah, I've done an analysis on Alta. ASML, we've also done analysis on. And Snowflake, We haven't looked at it on the platform, but I'm sure we can very quickly look at it. But it's got a 2.87 M score. Again, you can do a lot of the analysis on the platform itself if you wanted to. But I have done videos on Alta, done videos on ASML. Of course, ASML has been big part of our channel. And Snowflake, I have done videos, but I haven't looked at it recently. So we can take a look at it, in our future updates. Yeah, PayPal got rejected again. Not a surprise. We've got a huge resistance for PayPal. It's starting to kind of break out a little bit from its resistance of $65. But the next target's going to be at 68, right? So $68, $69, that's going to be that next resistance and target to watch for PayPal. Support level right now is $65. So yes, it got a bit of a rejection, but the good thing is that it's still breaking out of 3.5% higher, and the next target $68 for PayPal. Do you think we make new all-time highs before September? That's interesting. September, seasonality-wise, is one of the worst months for the market. August, I feel like, is also a bit of a coin flip. So if I were to guess, again, it's hard to say, but if I were to guess, the chances of us hitting new all-time highs are higher towards the back half of the year, which is October, November, December, especially fourth quarter, than they are in the months of August and September. It's possible that over the next couple months we do consolidate sideways, maybe even roll over. Just looking at seasonality into effect, because they're, again, the two really really tough months for the market, but October, November, December being very, very strong. Very strong months for the market. Yeah, Juan says PayPal value trap just by SoFi. Yeah, PayPal has been definitely, it's not really been moving all that much, although last couple of days it's done really well on the back of earnings, but yeah, it's definitely underperformed significantly. I mean, it's practically trading at the same level as it was back in 2017, I believe. So this is like a 6-7 year low for PayPal. Sergio, I'll definitely give a tour. I actually did an apartment tour for the apartment that I bought here in Dubai. So that's as part of our other channel, so Moneyvest Real Estate. We talk all things real estate over there. You can definitely check out the video on that channel. Yeah, CrowdStrike, it's a very difficult situation, right? So it continues to get hammered, down significantly from its all-time highs of 400. It's already down over 41%. It's lost tremendous amounts of market cap, just over 56 billion, and support level is going to stay put at $202. I'm actually curious to learn more about, what exactly happened. I know very much about what happened, but I don't know to the point where why is it important for CrowdStrike to have kernel access to a lot of the company's data servers and have full autonomy to push code, and again, just how can this be avoided? Why is it essential? And I feel like that's going to get a very technical conversation, mostly kind of explained by engineers, but I'm really, really interested. When I do find time, I am interested in learning more about what exactly happened here with, from a more technical standpoint. We know that, CrowdStrike's at fault, and that resulted in over 70% of all hardware powered by Microsoft to go down, give us the blue screen of death, but it's just understanding the different technical nuances of what happened that resulted in this. Because this is actually quite crazy, right? I mean, one company to take down the entire world, technology, I mean, how is nobody paying attention? How is nobody able to stop this? How is it so easily possible is what I want to know. So to be able to apply patches, security updates. So that's why they need, is what I'm assuming, that's why they need access to the most important internal access, right? That's what my understanding is, from allowing you to deploy things much faster. Got it. And can companies not do that themselves? Do they not have tech teams to take care of that? Anyway, so Jerome Powell is going to be talking in 4 minutes, folks. 4 minutes. We've got the speech starting. Votes, we were able to hit over 500, so thank you so much. We got 58% expecting that Jerome Powell is going to be dovish, with 42% hawkish. I'm going to end the poll now, and we are ready. I've heard it's so that they can bypass long approval checks from companies it works with. CrowdStrike was intel agencies and fighting guys. Don't believe clown. These ain't your normal clowns. I just bought 400 more shares so far. I've got 15,000 shares in a few accounts. Just around $8. Talk us out. On PayPal and 50 is only 200. That's good. That's good, Nolas. I like SoFi here at these levels. Imagine the guy who deployed it. Yeah, definitely sucks for him. And George Kurtz, I listened to a couple of his interviews, and he definitely does sound optimistic that everything is taken care of. Most of their customers are back online. But it just opens the companies up to huge amounts of vulnerability and threats, and it's just an unfortunate thing. I mean, it's something that should have really been accounted for. Like, a bad patch can do so much damage to the world. It's just incredible. Technology. This is only the beginning, I feel. It's so many things coming online with humanoid robots, autonomous driving. I saw a reel this morning. A burger was being delivered to a person using a robot. It was like a robot box in California, just like working and moving on its own on the sidewalk, trying to deliver a burger to a person who ordered it. And then it comes across, as unfortunate as it is, it comes across a homeless guy sleeping on the sidewalk, and then the robot's kind of like standing still because it's not able to go. It's not able to go anywhere. It's just incredible what's happening. Qualcomm pre-earnings. So Qualcomm is going to be reporting earnings later today, I believe. So after the markets close. Expectations, $9.4 billion. $9.4 billion in revenue and $2.30 in earnings per share. So that's going to be the expectations. Qualcomm's a fantastic business, I believe. 3.47 M score. I've done several analysis on this company in the past. I feel like it's one of the best high quality semiconductor companies out there with a ton of potential in 5G technologies, mobile phones, smartphones, IoT. So I really do like Qualcomm. I've done several analysis on this. So definitely, do check that out. If you come over to, let's say, some quick analysis on Qualcomm. By the way, we've got the event starting here. I'm going to quickly switch over. There we go. I'm going to do an audio check, everyone. So please do let me know if the audio is good. And we should be all set with Jerome Powell's speech, everyone. Please make sure that you drop a like, subscribe if you haven't already. Share this live stream with your friends and family who can also join us and listen to Jay Powell live talk about the same things that moves the world. Interest rates, inflation, all the good stuff. Okay, QQQs are going to be top right. We're going to move over to the 5-minute chart. So we got the QQQs here. You got the S&P 500 here. And we're going to bring over here Jerome Powell.
And I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low, 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping the longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So, on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier and we were to see higher readings for inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent, if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low, and we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low. So it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected. So that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen, significant movement in the labor market. And, we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this, we raised rates a year ago at the July meeting. And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress in the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we're to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months were reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12 month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer-Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, now labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question, the time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. So, but in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction. Whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. Just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there a reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown of the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
The mayor.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are it's just difficult to do. So I look at both. Yeah, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that, and then we have an opportunity to comment on that. Then we have an economic go-around, and then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this, and there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy, and so in the minutes we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and, a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we had to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And, when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time, discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So, more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things, the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed, because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
All right, everyone. So hopefully the audio was good enough towards the end. And the bottom line is, again, when it comes to the interest rate cuts, in some instances, talking about they haven't really pinned down anything about the next meeting or the meetings to come. They need greater confidence. They need to be a very, very data-driven approach. But at the same time, towards the end, he did mention that, okay, a rate cut would be possible, of course, if inflation was moving down towards their 2% target a little bit more consistently. Yeah, so I definitely do need to go to bed because it's been very, very exhausting overall. It is almost midnight here. I was a little bit bored out of my mind because it's something that we have already heard. It's a very similar speech that what Jerome Powell has already given. But nonetheless, I mean, we are seeing the markets push higher. Nasdaq's up a little bit over 3%. S&P's up over 1.7. A lot of individual stocks. Tesla's up almost 5%. We are seeing Nvidia also up almost 13% as well. So thank you so much, you guys, for joining in. I really appreciate that. I've sent the link for our members-only Moneyvest platform, including our Discord channel and our Patreon if you want to join, if anybody's interested. Link's going to be down below and also sent in the chat. Thank you so much for joining. Really appreciate it. And shout out to all of you guys for joining us during this live stream from all over the world. And appreciate you all. Take care.